Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about a topic that is, in my opinion, one of the most important topics to learn if you're interested in trading options, which is understanding the fundamental building blocks of all option strategies. And that's the four fundamental core strategies, which is long call, long put, short call, short put. If you're interested in trading complex strategies, it requires a fundamental understanding of these building blocks because, when we talk about these strategies like debit spreads, credit spreads, iron condors, butterflies, that's just scratching the surface in terms of how creative you can get when it comes to option strategies. When you get into diagonals and calendars, they start to get a little bit more confusing. But then if you start combining calendars with other strategies, it becomes impossible to understand them if you don't understand these fundamental building blocks. So today we're going to really break down these four strategies, make sure you understand them so that regardless of what strategies are thrown at you, for those of you that follow us on CNBC last week, Mike threw out a fairly, I would say, creative trade, selling a strangle and then using that to buy a call option. You could break it down in multiple ways. And if you understood the fundamentals, you would understand how those trades work. So today we want to make sure that regardless of how experienced you are, have that understanding so that you can continue to progress as a trader. So before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. And just a bit of housekeeping today, we're here to talk about, this buying versus selling options, understanding the fundamentals. Tomorrow morning, I'm doing another rapid fire session. This is where you guys have the opportunity to take a look at, under the hood, how I take an idea, flesh it out from the charts perspective, from a fundamental perspective, to gather whether I'm bullish or bearish and whether it's a trade that I might want to take using the stock or the option itself. Very, very good way for those of you that are learning how to find investment ideas to flesh out your ideas. So you guys submit symbols, you guys submit your symbols. I'll take a look at them and show you kind of where my views are. Next week, I think, is one of the most important topics for any investor. A lot of times we spend countless hours looking at charts, looking at strategies, researching, what are the best practices for trading and option strategies. But at the end of the day, we're putting money on the line. And when we put money on the line, the human psychology is weird in terms of how we view risk and reward. So next week, I want to talk a little bit about the psychology behind how professional traders view trading versus, the difference between a professional trader and everyone else that I see as a market strategist. I've been doing this for 15 years now. There's a distinct difference between traders who are successful and everyone else in terms of the way they think about risk and the way they think about each individual trade. Just so next week, I want to talk a little bit about what sets successful traders apart from everyone else. So if you are a current trader, or if you feel that you might be a little frustrated with your trading results, make sure you take the time to join us here next Thursday on Trading Psychology. And then the following Friday, we're going to do another members only market outlook session. This is where we just go over the broader markets, similar to what we do on Tuesday, and provide you with my outlooks. So for today, what we're going to do is we're going to start off by just discussing the basic difference between stocks and options. And then we're going to talk about the four basic strategies. So we talked about buying calls, buying puts, but I'm going to flip this around. I'm going to talk about buying calls and I'm going to talk about selling puts, the difference between the two, because it's a better way to position and understand the building blocks when you compare a long call to a short put. We usually think about comparing long calls to long puts, but they're basically the same thing. They're mirror images of each other. But if you think of it from buying calls to selling puts, you start to get a better understanding as to the difference between buying versus selling. And then we'll do buying puts and selling calls. We'll do a brief review of option Greeks and why that's important, especially for those of you that are relatively new. And then we'll try to cover as many examples as possible as we go along and open this up for Q&A here at the very end. Now, the primary thing that I want to help investors walk away from here today is really what is the fundamental difference between buying versus selling options. That is what we want to cover. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. Let's go ahead and get started. Now, before I do, can everyone please bring up the chat window at the bottom of your screen? And I just want to get a sense for the audience here. If you're brand new to options, and you're just learning, please type Y into the chat window. If you have experience trading options, please type N into the chat window. So Y if you're brand new, N if you have experience trading. Okay, so I see a lot of N's, meaning a lot of people who are experienced, but I also saw quite a few Y's in between. Okay, so for those of you that are brand new to options trading, this is a very, very important topic, arguably one of the most important topics if you have any interest in progressing into more advanced strategies. And for those of you that are currently trading or experienced in options trading, I highly recommend that you take the time to rethink about your understanding of the fundamental building blocks to give you a better understanding as when you're trading those more complex strategies. How do you go about thinking, managing them? And how do you think about starting to create variations of them to fit your investment profile? Because we all have different views in the market. I might be very bullish on a stock. You might be less bullish on the stock, but we both agree that we're bullish on the stock. But depending the degree of bullishness that we have on a stock, that will determine what is the optimal strategy for you. So if I tell you I'm very bullish and this is strategy that I'm taking, but you agree with me on the direction, but you don't agree as to how bullish, by learning these topics, you can make modifications, you can make adjustments to your own strategy and modify them for your outlook. That is the goal that I want to achieve through these sessions here today. So let's go ahead and get started. So first, I want to talk a little bit about just stock trading. Most of you are familiar with stock trading. This is what we call a true bullish or bearish exposure. Meaning, when we talk about stocks, buying a stock is what I consider bullish. Shorting a stock is what I consider bearish. That is the pure term of bullish or bearish. And why do I say pure? Because it is the only strategy that gives you immediate gains if the direction is correct. Meaning, if you buy the stock and the stock moves up even by a penny, you start making money. If it goes down by even a penny, you start losing money. And the directional exposure that you receive is symmetrical. If you buy a stock at $180 and it goes up to $200, you make $20. If it instead goes down to $160, you're going to lose $20. It's dollar for dollar in terms of the exposure you get. It's symmetrical. So it's really easy to understand. This is why stock trading from a conceptual perspective is relatively easy to wrap your head around. And you can trade a stock or buy a stock and hold on to it for as effectively as long as you want, especially if you're trading on a cash account, because once you buy the stock, there's no time horizon on it. You can hold on to it for as long as you want. The only limitation with stock trading is that there are no neutral options. Meaning, if you think the stock is just going to move sideways, maybe you think it's going to go up a little, down a little, but you think largely it's going to stay where it is, you don't really have any neutral options. You're not going to be able to make any capital gains on a stock that is moving sideways. But on the other hand, when you trade options, you have a lot of options. Sometimes I think for many investors, you might actually feel there are too many options. So first of all, as an options trader, what you realize is that the vast majority of expiration dates and strike prices have zero open interest, zero volume. No one ever trades them, but they're there. They're there for you to trade if you want it to. But largely, most people trade shorter dated at the money options for the most part. So let's talk a little bit about the 4 basic strategies. And I'm not going to jump through, all the details, especially since I know many of you already know the basics here. But just a quick reminder for those of you that are brand new, I have a little trick for those of you that are brand new to help you remember which strategy is which. And all you have to do is assign a plus or minus sign. I usually assign a plus sign to buy, a minus sign to sell, which I think is pretty self-explanatory, and then a plus sign for calls and a negative sign for puts. And all you have to do is basic multiplication to determine whether you're trading a bullish or bearish strategy. So A long call is a positive and a positive. So when you multiply a positive with a positive, you get another positive. That's why we know long calls are bullish. On the flip side, if you multiply a negative with a positive, a negative with a positive, and this should be negative. I apologize. Just realize that this should be a negative. When you multiply a positive and a negative, you get a negative, which tells you a long put is bearish. And then a short call, which is, a short call, which is a negative and a positive, again, is also a negative. That's why a short call is bearish. And then only in a short put, which is a negative and a negative, do you get a positive. And that's how you can remember a short put is bullish. But when we refer to these strategies as bullish and bearish, it's not actually, in my opinion, 100% accurate. It's a somewhat accurate statement. And today what we're going to discuss is why these statements, while largely true, is not 100% accurate. So we're going to break down these four strategies. Like I said, what we're going to cover is actually buying a call first and then selling a put, because these are the two bullish strategies. And that really allows you to compare buying versus selling. And then what we're doing is we're going to do a long put and then a short call, because we're not comparing bullish and bearish. We're comparing buying versus selling. Those are the two sides to an option contract. Remember, when you're trading an option, you're entering a legal agreement between two parties. You can either be on the buyer side of that party or you can be on the seller side. So it's extremely important that when you're trading options, you understand both sides. What are the obligations or what are the rights that you have as a buyer? What are the obligations that you have as a seller? If you can understand those two things, you are set in terms of your understanding of options, and you are able to then take that understanding and apply them to more advanced strategies. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Perfect. Okay, I see a lot of ones. So let's jump right into it. First one I'm going to take a look at is buying a call option. Many of you here are well familiar with a call option. So I'm going to use example stock XYZ trading at $100. Let's say I think the stock's going to go higher. So I buy a call option. Now, again, we refer to a call option as bullish, but the more accurate description for a long call is bullish by a certain amount. Now, what do I mean by a certain amount? The certain amount depends on how much you pay for that call option. Because if, let's say, I'm bullish on stock XYZ and I buy an at-the-money call option, and let's say I pay $4 for that call option, the call option, what it provides me with is the opportunity to take unlimited upside. So if I'm right and the stock goes higher, I participate in unlimited upside on this particular stock, or rather on this particular option if the stock continues to move higher. And my downside with a call option is the fact that no matter what happens, the most I can lose is the $4 that I pay. So for a lot of investors, when you first look at the strategy, you say, wow, I can get unlimited upside if I'm right. And I only have to pay $4 to get into the trade to control a $100 stock. Instead of paying $100 a share, I'm only paying $4 a share. I get unlimited upside, and my losses are capped at just $4. No matter what happens, even if the stock goes to zero, I can only lose $4. Doesn't that sound great, right? I mean, why wouldn't I always do this? Why would I ever buy a stock and risk a full $100 and have to put up $100? And that's a great question. The downside to this strategy really comes from the fact that you have to pay the $4 a share to get into the contract. And that is what you have to overcome in order to break even on this trade. So just to say that I'm bullish on a stock and go out there and buy a call option is not a great idea, because if the stock moves higher, yes, you can potentially make money. But in this particular case, if the stock moves a little bit higher, guess what? You can actually still lose money on this trade because your break-even price is $104. It has to actually go above $104 before you turn a profit on this particular trade. So and many investors will say, okay, I'll take that risk for $4 a share. I'm only risking $4 a share. If I'll take on the risk that if stock goes higher, the stock has to go much higher before this turns a profit. But when you actually go about thinking about this, right? So yes, you're protected if the stock goes down. You lose money if the stock goes down. We all know that's the case, whether you buy the stock or buy an option. But if the stock doesn't move, you also lose money, right? Because if the stock goes lower, you lose money. If the stock stays the same, you also lose money. If the stock goes a little bit higher, anywhere from 100 to 104, you still lose money. Only if the stock makes a big move to the upside do you make a profit, which means that if you think about this as like one scenario, two scenarios, three scenarios, only 1 out of 3 scenarios are you actually profitable on this particular trade. That is by far the biggest challenge that you have with buying a call option, is that you have to overcome the cost of the call option. And sometimes the call option may not just be $4. It might be $10 or $15. The more expensive that call option is, the more the stock needs to move before you're profitable. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. So that is the challenge that you have whenever you're buying an option. You have to overcome the cost of that call. So that's what I say, bullish by a certain amount. And that certain amount is determined by the cost of that call. Because again, if this call didn't cost $4, let's say this call cost you $10, then your break-even price is 110. The stock has to get all the way up to 110 just for you to break even. That means you have to think the stock's going to go to 115, 120 to be able to make a profit. So remember, break even just means that you've broken even. You have to believe that the stock's going to go to 110 before you really turn a real profit on this trade. So on the flip side, if we look at selling a strategy to potentially be profitable, let's take a what that looks like. And that's where selling a put comes into play, right? And many investors, when you first take a look at selling a put option, especially compared to buying a call option, sounds like a terrible idea. You have stock XYZ trading at $100. Same example, you think the stock's going to go higher. So you look at selling a put option. So selling a put option is what I call somewhat bullish, but not too much. What do I mean by that? Let's say I take let's say I'm bullish on stock XYZ. I sell a $100 put. And because I'm a seller, so before I'm a buyer, I have to pay the premium. Now as a seller, I collect the premium from the buyer. The buyer has the right to exercise their contract. The seller has the obligation, if the buyer chooses, to exercise their put or call. So as a seller, I collect the $4 profit. Now, as an option seller, the most I can make, no matter what happens, is the $4 that I collect on this trade. So if the stock goes from 100 to 110, I make $4. If the stock goes from 100 to 130, I make $4. If the stock goes from 100 to 1,000, I still only make $4. So the most I can make is this $4 that I collect on my short put. What's my risk? My risk is actually fairly substantial because when I sell a put for $100, I'm obligated to buy the stock at $100 from the buyer. So if, let's say, the stock was to decline, let's say the stock declines substantially, let's say the stock goes from 100 to 0, I'm still forced to buy the stock from the buyer at $100. That is worthless to me. So I'm going to lose a substantial amount of capital. So when you look at a short put, especially if first-time viewers, you look at this short put and you say, wow, the long call, I'm only risking $4 and I can make unlimited potential profit. But when I sell a put, I have unlimited downside. Well, technically, it's not unlimited because the stock can't go below 0. And in exchange for that, the most I can ever make is the $4. That doesn't seem to add up. Why would anyone ever enter this type of contract? If you've ever thought that, please type 3 into the chat window, thinking to yourself, selling options sounds like a terrible idea, right? And largely, this is on paper, doesn't sound particularly great. But remember, in the first example, I showed you 3 possibilities, only one of which you're profitable. But on the flip side here, when we look at selling a put option, if I'm right, if I'm right on my direction, so I think the stock's going to go higher, right? So if the stock goes higher, I make $4. Now, if the stock doesn't move, meaning I'm not right, but I'm also not wrong, guess what? I still make $4. Now, what if I'm wrong, but just by a little bit, right? So I think the stock's going to go higher, but instead the stock goes lower, but just a little bit. It goes from 100 down to 98. Guess what? This is one of the only strategies where even if I'm wrong on the directional view of the stock, I can still make a profit because I collected $4 by selling the put. That's the buffer that I have in being wrong. I can be wrong by $4 in this particular case. I think the stock's going to go higher, but I have a buffer of $4. So meaning if the stock goes down to 96 bucks, between 100 and 96, I'm still profitable. Only if the stock goes below 96 do I actually lose money. And keep in mind that I'm losing money proportional to the stock moving lower. So if the stock moves $10 lower, I'm not really risking unlimited amounts of capital. I'm only risking, in this particular case, $6. If the stock goes from 100 to 90, in this particular case, I lose $6. But remember, my reward here was $4. So a risk reward ratio here is not actually as poor as many investors perceive it to be. And that unlimited risk is always something that concerns investors. But remember, the stock has to go to zero for that to happen. And there's an expiration date. It has to go to zero by that expiration date, which largely is hard to do in terms of, for a stock to go to zero between now and let's say 30, 40 days from now. A lot really has to happen for that to appear. So remember, when you're selling an option, what happens is that in scenario 1, you make money. In scenario 2, you make money. In scenario 3, you lose some money, but you're not really risking a ton of money in that particular case. So remember, that's why whenever you're selling an option, it's a forgiving strategy, because if you can get the direction right, you're going to make money. If you're not right or wrong, you'll still make money. And if you're wrong, you can likely still make a little bit of money. But if you're really wrong, yes, you do have, in theory, unlimited losses. Does that make sense, everyone? Please type 4 into the chat window. So what sounds like a really good proposition here in terms of unlimited gains in exchange for limited losses is actually not as great as you might think. And on the flip side, what sounds like a really terrible strategy of having limited reward with unlimited risk is actually not as bad as you think. Okay, so that's the lesson that I want to teach investors here between buying versus selling. Okay, does that make sense? Please type 5 into the chat window if that makes sense to you, that buying an option on paper sounds great, but it's actually quite challenging to ever make money on that strategy. And then selling a put sounds like, or selling option strategies in general sounds like a terrible options proposition, is actually substantially better than you might imagine. Okay, so let's take a look at a real example. I think that's the best way, in my opinion, to take a look. We'll just use Apple as an example. I always like to use big cap names that we're all familiar with. Let's just look at buying an April call versus selling an April put, for argument's sake. So this is the OptionsPlay tool. Most of you already have access to the tool. If you haven't used this before, we'll show you how to access this. But the tool itself is broken down into 3 sections. You have your trade ideas, watches, and portfolio on the left. In the middle, you have your security analysis panel. And on the right-hand side is our trading and income panel. So what we want to compare is selling the put to buying a call option on, let's say, a stock that I think is going to go higher here. So what I'm going to use my P&L simulator, and I want to simulate how these strategies perform. And what I'm going to do is I'm going to first look at the break-even price of this type of strategy. So as you can see, if I bought the April 135 call, it's going to cost me $7.55 or $755 for every 100 shares per contract. My break-even price is 142.55. Let's just take a look at this chart. 142.55 is up here. Now remember, 142.55 is my break-even point. That doesn't mean I make a profit. That just means that if the stock goes from this to this, I break even. And it has to be above that before I make any profits. So anything below that, below 142.5, Anything here, 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 I'm actually losing $755 on this particular trade. The stock really has to be above that level for me to make any profits. On the flip side, if I sold the put, my break even is 127.85. 127.85 is down here, which means that on the flip side, if I sold the put, I make money here, 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 I make money here. I only lose money if I get down here, and I really lose some real money if it gets down there. Okay, so that just gives you a visual sense of like where you make money, where you lose money on these types of strategies. And you can use our P&L simulator to also see, if the stock goes higher, how much do I make? So here's the stock's at 135. I'm bullish on the stock. Let's say by April, the stock moves a little bit higher, but not a whole lot. It moves to 142. If I sold the put, I make my $715. If I bought my call option, I lose $55. So because again, the stock has to move quite a bit before I'm profitable. So if it only goes up to 142, guess what? I'm losing money. And so what you have to think about is not just when do I make money on the call option, but when do I start to outperform selling the put option? So yes, the put option has limited gains, right? You can only make $755. But at what point does the call option make $755? It actually has to move up to about $150 or so, about $150 or so before the call option makes a $759 profit. So it's not just $142 that I'm concerned about, which is the break-even point. It's actually about $150 or so when the call option makes more money than the short put. Okay, so now you look at this trade and you say, wow, do I think Apple's going to be above 150 by April? Now, perhaps you're very bullish on Apple and you have views that, there's a catalyst between now and April that's going to propel the stock above 150. And if that's the case, by all means, the call option is by far the better strategy. But if you're not as bullish and you're concerned that maybe the stock gets up to 140, 145 or so, you'll see that even at 145, a call option will only make you a $245 profit versus the short put would make you a $715 profit. So these are the things that you have to factor when you're thinking about these types of strategies and whether you're thinking about buying or if you're selling. And now, for those of you that are just starting out, that's the first question that you have to answer. For those of you that have a little bit more experience and you're trading more complex strategies, this is the difference between buying a debit spread and selling a credit spread. This is fundamentally the decision that you're making, because a credit spread is really just taking this short put and adding another put to it so that you have limited losses, right? That's exactly how you create a short put. Whoops. No, I'm sorry. Short put vertical. What you're doing is you're selling this a credit spread here. So you're selling the 135s and you're buying, let's say, a 125 or a 122.5. That reduces your overall risk, but it also reduces your overall income. And then when you're trading a call like this, and you think about trading a debit spread, what you're doing is you're simply buying that same call and selling another call against it. And what you're doing is you're trying to reduce the cost of that trade. And by reducing the cost of that trade, you are improving your probability of profit so the break-even price is lower. But these are the decisions that you're making when you're deciding between a credit versus a debit spread. So for those of you that are a little bit more advanced, this also gives you some insights into how do you go about deciding, should I buy a debit spread or sell a credit spread? So let's jump back to the options to the presentation real quick. I'm just going to go through very quickly the opposite or the mirror image here. So if let's say I have stock XYZ that I'm bearish on, meaning I think it's going to go lower, yes, I can buy a put option, which gives me basically unlimited downside all the way to zero. I can't make any more money because the stock can't go below zero. But for that, I'm only risking $4 a share, because in this particular case, I paid $4 for this $100 put option. So when I pay $4 for the put option, the most I can lose is $4, but that means that the stock has to get below 96 for me to break even. It has to actually go below 96 before I make a profit. If it goes lower, but not as much as 96, I actually still lose money. Actually, especially for those of you that have experience trading, how many of you have purchased a put option or a call option, got the direction right, meaning the stock went either higher for a call or went lower for a put, and then you still lost money on that trade? Please type 6 into the chat window if that's ever happened to you. I see a lot of 6s, okay? And that is the challenge that you have with buying an option. If you're bullish on a stock and you bought the stock and the stock went higher, you would make money. But with the call option, the stock can go higher and still lose money. And I think that is probably the most disheartening thing to learn about options, is to get that direction right, get the magnitude wrong, and lose money on that trade. So that is why when we talk about investors, or specifically professional investors, if any of you have ever heard this concept that professional investors prefer selling than buying, it's because of this reason that, first of all, the way that option prices are priced is based on the volatility of the market. So when we talk about $4 debit, the market is already pricing in what it's expecting it to move by, and it's priced based on what the market is expecting the stock to move. So for you to buy a call or a put, you're basically saying the market has gotten the volatility of this stock wrong. I think this stock is more volatile than what the whole market is anticipating, and that's why I'm buying the call or put option. That's effectively what you're saying when you're buying a call or a put. On the flip side, when you're selling a call or a put, now this is the part where I'm not a big advocate of selling naked calls, because this is one of the true option strategies that has unlimited risk. It has the same unlimited risk as a short seller of a stock. So many of you have seen what's happened to short sellers over the past few weeks with stocks like GameStop. And if you shorted a stock at $20 and it's now trading at $400, you have to come up with $380 per share, or $38,000 per contract that you sell on a stock like GameStop. Now, I'm not saying that's going to happen to you when you sell a call option. Now, and there are many ways to protect yourself, like selling a covered call. But if you sell a naked call, you truly have unlimited risk, the same risk that those short sellers took on. So that's why I'm not a big fan of selling. I would never advocate for selling a naked call option, but you have the same premise as selling a put option. The fact that if you get the direction right, you make the premium that you collect. If you get the direction incorrect, but the stock doesn't move, you still make that same amount of money. You can actually get the direction wrong and still make money. Only if the stock moves substantially against you do you lose substantial amounts of money on this particular trade. But this is one of the only trades that has truly unlimited risk. So if you're going to sell a naked call, consider selling a credit spread that limits your risk here to the upside. So if the stock takes off, you have limited risk on your overall strategy. Does that make sense, everyone? Please type 7 into the chat window if that makes sense to you. Perfect. Okay. So let's just talk a little bit about option Greeks, because, and this is more for those of you that are on the newer side of options, because, we've talked about, buying a call or a put if the stock goes higher and lower. We talked about these strategies at expiration, but largely as options traders, we never ever hold these trades to expiration. We usually buy a call and we'll usually sell it well before expiration. And if we're selling a call or a put, we generally will close that out before expiration as well. So a lot of investors will say, okay, then how do I determine what my potential profit or risks are before expiration? And this is really where we turn to the Greeks. So the first one we're going to cover is delta. Delta tells us the impact that the directional move of the underlying stock has on the option itself. It also tells us the leverage factor that we have on the option itself. So delta gives us a sense for the change in the option price with respect to the change in the stock price. And this helps us with strike selection. So many of you, if you've looked on the options chain here, let's say I was to buy the 135 calls. The 135, notice on my screen, there are three if you notice on my screen, there are three numbers. There's 135, which is the strike price. There's a 755, which is the premium of the option. And there's the 0.53. That's the delta. Delta tells me the sensitivity of that option to a $1 move in the underlying stock. So if I bought the 135 call and the stock goes from 135 to 136, $1 move in the underlying stock, I should expect my option that's currently worth $7.55 to increase by roughly 53 cents to about $8, and let's just call it $8.10 or so. So that tells me that if Apple stock goes up by $1, I should make about, in this particular case, 53 cents on my $7.55 option. That's what Delta tells us. Does that make sense, everyone? Please type 8 into the chat window if that makes sense to you. And for a lot of investors that ask, I also get a lot of questions from investors saying, why would you ever buy an out of the money option? Or why would you ever buy an at the money option when you can buy an out of the money option? They're really, really cheap. And if the stock makes a big move, you can make a really outsized return. Well, the answer is that for every $1, so let's say I buy a 160 call option, a way out of the money call option. As you can see, the delta is 0.14, which means that if the stock goes from $135 to $136, my $1.33 option right here, $1.33 will increase by only 14 cents. So here it'll increase by 53 cents. Here, it'll only increase by 14 cents. So Delta tells us the sensitivity of the option. There's another aspect of Delta that for those of you that are new, you may not be aware of, but Delta also gives us a sense for the probability of the stock being above, of the option being in the money at expiration. So what that means is that there's a 14% chance that Apple will be above $160 by the April expiration. There is a 96% chance that Apple will be above $102.50 by expiration. There is a 98% chance that the stock will be above $77.50. And you can use Delta to select your strike prices. It's a very, very useful tool because Delta naturally adjusts for volatility. If Apple has earnings coming up, all the strike prices, all the deltas will naturally get further away. If there's no earnings coming up, the deltas will naturally adjust in. This way, you will always adjust for the expected volatility of a stock. So when you're selecting strike prices, if you're looking for a more consistent way of selecting strike prices, Delta is going to provide you with that opportunity. The second most important Greek to understand is theta. Time value. Theta gives us a better understanding as to how much premium, how much decay we can potentially have on the option. So if you have a theta of 0.03, that means your option will lose 0.03 cents per day. So before we talked about an option that was $7.55. If let's say this option had a theta of 0.03, that means if everything else stayed the same, meaning between today and tomorrow, the stock price didn't move. The only thing that changed was the fact that time went on by a day. My option tomorrow will be worth $7.52, $7.49 the day after, $7.46 the day after that. And what you have is an erosion of the value of your option as time goes on. So that's the break-even price that we're talking about. So as every day goes by, the value of your option will go down. So what you have is theta working against you as an option buyer. And what you have is delta potentially working in your favor, because if the stock goes higher, you make money. So just to give you a numeric example here, I have an option with 0.5 delta. If the stock goes from 100 to 101, then my $5 option will gain by 50 cents, right? Because for a $1 move in the underlying stock, my option will move by 50 cents. So when the stock goes from 100 to 101, my option will go from $5 to $5.55. But with theta or time value, let's say it makes that move from 100 to 101 in the time of 1 week. So what happens is delta will contribute 50 cents in gains, right? So $5 to 50 cents, $5.50. But because 1 week goes by, which is 3 cents a day multiplied by 7 days, gives me a loss of 21 cents. So I would have to subtract 21 cents from the value of my option. So if a week goes by and the stock goes up by 1%, I basically make a 5.8% gain because the stock makes 50 cents by delta, but loses 21 cents due to theta. So I have only a 5.8% gain versus a 10% gain if the stock made that jump overnight, if you will. Does that make sense, everyone? Please type 9 into the chat window if that makes sense to you. And Jeffrey asked a question, if this was in trading days or this is in calendar days. Well, guess what? Time doesn't stop on non-trading days. So yes, these are calendar days, not trading days. So, and the other thing to remember here is that time value. So when we talk about time decay is only going to erode the extrinsic value of an option. Because whenever you look at an option price, it's always made up of 2 components, an intrinsic value and an extrinsic value. So when you buy an in-the-money option, most of it is going to be intrinsic value. But when you buy an out-of-the-money option, it's all going to be extrinsic value. So this is the part that will erode. Extrinsic value will erode. Intrinsic value will never erode. It will always stay there. So whenever you're buying an out of the money option, that is where you're going to have the most time erosion. When you buy an in the money option, that's when you're going to have the least amount of time erosion. So whenever you're trading an option, when you're buying, your goal is to minimize time decay. That's why we buy longer dated in the money options whenever we're buying an option. That's to reduce the time decay factor. And when we're selling option, we prefer to sell shorter dated out of the money options because that's when we maximize that time decay. Because when we're selling, we want that time decay to actually work in our favor. So in my example here before, if let's say I was the seller of this option, I want time decay. I want this to erode because if I sold something for $5, I want it to erode as quickly as possible every single day I hold on to it. The faster it erodes, the more money I make, or the faster I make my profits. As an option buyer, I want to minimize my time decay because the smaller the time decay, the more I have time for delta to work in my favor. So you can think of theta as something that constantly work against the value of your option each day you hold on to it. And what you're trying to do as a buyer is you're trying to have the delta work in your favor so that it overcomes the loss that you have to theta. And then if you're an option seller, you're doing the exact opposite. You want to maximize time decay every day you hold on to it, that decrease the value of your option, and hope that delta does not offset the total gains that you have as an option seller. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Perfect. Okay, so that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of just the fundamental building blocks of options. You know, taking a look at single leg options, understanding them at their core is integral to being able to look at more advanced strategies, being able to take the ideas that we just showed you and construct more creative strategies beyond just debit and credit spreads, looking at calendars, looking at diagonals, maybe even combining multiple complex strategies together. It's all based on these fundamental building blocks. So with that, you know, if you have any questions, what I've done is at the bottom of your screen, there's a chat window and a Q&A window. If you have any questions, please bring up your Q&A window and I'll answer some questions as much time as I have out of the Q&A window here for everyone. Peter, Bruce, Christopher, you're very welcome. Baby steps, absolutely. If you're brand new, you know, I always tell investors, if you're brand new to options trading, you want to give yourself about 3 months or so to absorb all of this information. We have a lot of information on our YouTube channel. I'll post a link to our YouTube channel, which is where we have a lot of the recordings. So you can actually look at our previously recorded videos. I just sent a link into our chat window there. I just sent a recording, a link to our chat, to our YouTube channel there. If you want to look at some of our other videos, all of them are available there. David is saying, will this set of slides be available? All of the videos that we produce, the recordings, we have the links in the description. So, I'm sorry, the links to the slides in the description. So any YouTube video, any webinar recording that we send to you, just look in the description YouTube. It will have a link for you to download the slides. So you get the recording and the slides afterwards. Barry is saying, hi, Tony, can you talk about the gamma squeeze? I've heard about it regarding the GME craziness. So Barry, here's the thing. It's been written up 1,000 times. The best thing I think I can do for you is point you to Google, to be perfectly honest, because it's gonna take me too much time to try to explain gamma and short squeezes, and there's just a lot of information already out there that's very good. So Barry, I recommend that you go online and do a little research there. Naresh is saying, how about IV? I'm not sure what you mean by how about IV. IV is referring to implied volatility. Naresh, if you have a question specifically about implied volatility, please let me know. Ed is saying, when selling a naked put, when is it likely to be put to you if it goes against you? So generally speaking, a short put will only be exercised near expiration. That's generally true with any option. It has really had nothing to do with the short put nature of it. But options will always generally have a higher probability of being assigned within the last week of expiration. Ram is saying, the OptionsPlay trading platform says bearish on a stock and the credit spread says bullish on the same stock sometimes. Ram, so here's the thing, right? The credit spread report is finding optimal credit spreads. Now, you can the thing about credit spreads is that you can sell a credit spread on a bearish stock, right? It's kind of like saying that's like saying you can't pick a market bottom, right? So you can have a stock that's bearish. What was the symbol that you said? XPEV, right? So, yes, the trend is bearish, but I wouldn't say that this is a very bearish trade per se, right? Because you have a support level here. Because, when stocks move to the downside, those are your prime opportunities to sell, right? So when things get bearish, those are your opportunities to sell a put credit spread. So don't be afraid, if you will, just because you have a bearish trend. And plus, this is a 1 month bearish trend, right? If you have a 1 month and 6 month bearish trend, I would be a little bit more concerned here. But overall, the longer term trend here for this stock is still higher. So I wouldn't be too concerned about that. Why don't we always buy dip in the money calls? Why don't we always buy dip in the money calls? I'm not sure what you mean by why don't. I mean, there's a million things that we don't do. So I don't think that's necessarily fair. I mean, we generally prefer selling put credit spreads during a dip here. But that's, again, because of the reasons I just showed you, right? Because you can make money if you're right, you can make money if you're not right, and you can actually even make money if you're wrong on the particular trade. So those are higher probability trades. Those are the ones that we tend to prefer trading. Ed is saying stop limits. My broker Fidelity doesn't offer the ability to place stop limits on spreads. I can only place a stop limit on each individual leg. If that's the case, Ed, I highly recommend you consider moving to a broker that does support stop limits on a spread. I'm surprised that Fidelity doesn't offer stop limits on a spread. I would call them up and confirm that before you move your assets somewhere else. Cover Vega, please. Vega is just telling you the sensitivity of your option to a 1% change in implied volatility. So if the volatility moves by 1%, how much the value of your option changes. So here's the thing about Vega, is that Vega has a relatively small impact on your overall P&L. Delta has the largest impact. Even a small change in the underlying stock will cause a big move in the option. Time also has a relatively small factor in your P&L. Vega has an even smaller move. And plus, implied volatility is don't move a whole lot. You really need some complete change to the way someone views a stock for implied volatility to change a whole lot. The stock price can move a whole lot. Time obviously is constant, and implied volatility, generally speaking, is fairly constant. Do you look at delta and theta with every trade? I look at delta on every single trade. I don't look at theta very much. Theta, there's really not much you can do about theta. Theta's there, you have to understand it, but there's not much you can do about it. Delta, I use to help me select my strike prices. Mark is saying, best scenario, what's the best percentage when selling an out of the money put? I'm not sure what you mean by the best percentage. We usually sell about a 40 delta put when we're selling a put, if that's what you mean. How is implied volatility determined? Who determines it? The market does. The market determines the price of an option, and you back out the implied volatility from the price. So that's like saying who determines the price of Apple. No one in particular does. The whole market as a whole, all the participants in the market as a whole effectively agree to a price. The last traded price is what we deem as the price of Apple stock. So whatever the last traded price of an option is, we use that price to derive the implied volatility or the expected future volatility of the stock. There is a definition of delta being number of shares less than 100. How to use this definition in analysis? So Jay, that's exactly what I'm referring to. It's the leverage factor. So for every $1, so the reason that when you're talking about number of shares, that's exactly what we're talking about, right? Because if each contract is worth 100 shares, right? So if you have a delta of 0.5, that's the equivalent of being long 50 shares. So think about it. If a stock goes up from $5, if a stock goes from 100 to 101, you would normally expect a $100 gain if you had 100 shares. But because you have a delta of 0.5, you have the equivalent of 50 shares. That's why your gain here is only $50. So that's why your gain is from $5 to $5.50, because you're only gaining half as much. So when we refer to a delta of 0.5, we're always talking about a fraction of 100 shares. It's the equivalent of owning 50 shares as opposed to owning 100 shares. That's what delta is referring to. Is the theta value curve change over time? Yes. So theta value curve constantly changes. With every change in implied volatility, the theta curve will change. Can I use tools on OptionsPlay to work an SPY, SPX cover call easily? Yeah, I mean, you can just type in SPY. You're not going to get a lot of premium from selling, generally speaking, cover calls on ETFs, especially in the lower volatility environments that we're in. But absolutely, you can type in a symbol. All you have to do is click on the income tab, and you can look at cover calls here on SPY. How do you calculate the profit on an options trade? Jay, I would say it depends on what kind of options trade. But generally speaking, the rule of thumb for calculating your profit on an options trade is to take your profit minus the margin requirement or the capital required to get into the trade. Ram is saying, I have a cover call stock that went up very high, around 300%. The options expiration is sometime in August. Is there any strategy to close that position without losing the premium? I don't know what you mean by closing the position without losing the premium. Ram, at the end of the day, when you sell a cover call, what you've done is you've obligated yourself to sell the stock at a specific price. There's no way to get out of the obligation if that's you're asking. That's the obligation that you took on when you sold a cover call. When do you sell a call option? When do you sell a call option at a percentage gain or days before expiration? Great question. I think, Richard, is what you're asking is, if I buy this call option for $1,215, at what point do I sell it? If that's your question, the rule of thumb that we generally have is, first of all, you cut your losses when you've lost 50% of the premium that you've paid. So if I pay $1,200 for something and it's now trading at, let's say, $600, it's time to cut my losses and move on to the next trade. On the flip side, if the trade goes about 75% in my favor, 75% gain, it's time to start taking profits anywhere between 75 to 100%. Those are the general rule of thumb as to when you might want to take profit or roll that trade into a future contract so that you can lock in some gains. What's the best duration to sell credit option, like 2 to 3 weeks? The optimal credit spread, the optimal option selling time frame is 45 days from expiration and buying it back roughly 21 days from expiration. The time frame between 45 and 21 days, that's when you have the fastest amount of theta with very little gamma exposure. Gamma works against you as a short option seller. So a lot of investors like to sell options in the last couple of weeks because they say to themselves, theta is highest during that time. And that is a true statement. But when you have theta working that fast in your favor, you also, on this flip side, have a lot of gamma risk. And in the last 2 weeks, the gamma risk starts to outweigh the acceleration that you get in theta, which is why we always avoid selling options in the last 2 to 3 weeks. Simon is saying, how can you break down the OptionsPlay score to better understand? The OptionsPlay score, think of it like a risk to reward ratio. It tells you whether the risk to rewards are skewed slightly in your favor, whether they're normal or they're slightly skewed against you. At the end of the day, we consider option markets largely efficient, meaning there aren't a lot of inefficiencies in the market where you found some profound inefficiency and you've found some kind of arbitrage opportunity. But the OptionsPlay score gives you a sense for whether things are slightly skewed in your favor or slightly skewed against you. When you have a really high OptionsPlay score, it does not mean in any way, shape, or form that you're going to make a profit. It simply means that if the trade goes against you, you're likely to make a slightly higher than normal profit. And if the trade goes against you, you're going to make a slightly smaller loss. So the OptionsPlay score gives you a sense for the risk to reward ratio, meaning how much potential green is there versus how much red, and the ratio between the two, whether that's skewed slightly in your favor or slightly against you. And that's color coded so that you don't have to remember the scores. You just have to know red means relatively poor risk to reward, yellow is average, green is good risk to reward. Kathy is saying, the issue I have with selling puts is that it takes so much capital. You're absolutely right. Selling a put does take a lot of capital, which is why we prefer selling put credit spreads. You effectively get a very similar risk profile, but you're doing so with limited risk. So if I sold just the put option, let's just give you a sense here. If I just sold the put, I would need roughly $37,000 in capital to sell this one put. I'm collecting $1,200. Here, to sell a put credit spread, I only need $1,700. Yes, I've reduced my income in half, but I've reduced my capital requirements in this particular case by a factor of almost 20. So this is why we much prefer selling put credit spreads. It's far more capital efficient to sell credit spreads than it is to sell a short put. Mark, thank you so much. What is the risk reversal strategy with options? A risk reversal strategy is when you sell an out of the money put. So for example, if I sell, let's say a 375, and then I buy an out of the money call. So let's say I do something like that. And the key here is, you see how there's the jagged line, right? The jagged line that looks like this in this graph. And then in the middle, there's a line that looks like that. If you notice that middle line, what does that look like? It looks like long stock. Because that's really what a risk reversal is designed to do. It's designed to mimic a stock position in the short run. So people trade these risk reversals, generally speaking, in an earnings event because it provides a little bit of protection to the downside if you're wrong, right? Especially if you hold it to expiration. But if the stock makes a big move to the upside, you participate in it similar to a stock position. So that's what a risk reversal is when you're selling a out of the money put and buy an out of the money call. Victor is saying this morning the Peloton option had almost no liquidity. Can you discuss your thoughts on what activity is enough to place a credit spread? My question to you is, Victor, how did you determine that Peloton had no liquidity? I mean, you're talking about a stock that trades 4.25 million shares a day. I hardly would consider that something that doesn't have any liquidity. If something trades a few 100,000 shares a day, I would agree with you. But something that trades 4.25 million shares a day, because options liquidity is simply just a factor of the stock's liquidity. If something trades 4.2 million shares a day, that is very, very liquid in my opinion. You will get filled on an option. So, whenever we look at liquidity, we look at bid-ask spreads, right? So if we look at the Peloton trade, the March 145, 135s, just to give you a sense here. It was trading about 585 by 685. The mid price was 640. You should have been able to get filled at about $6.30, $6.50 on that particular trade by working this order. So, a lot of people are concerned about liquidity. When you have something that trades 4 million shares a day, you shouldn't be concerned about liquidity. I understand that it might not look very liquid, but this is really where we try to educate you, Victor. We actually have a video on this on YouTube where we talked about, maximizing your orders and sourcing liquidity and understanding a little bit as to what the mid price tells you. The mid price gives you a sense for what's the fair value. That's how you should start your negotiations. Remember, these are just computer algorithms. You can continue to hammer them and source liquidity. Put in an order. If it doesn't get filled, place another order. Continue to place orders until you get filled. So that's my view. Look at how many shares of the underlying stock is traded. I like selling puts on names that I want to own. Any advice on picking strikes in this scenario? So Jim, when we sell puts on stocks that we like to own, we have to time the markets a little bit, right? You generally don't want to sell puts after the stock's made a big run. You generally want to wait for a bit of a pullback here. And usually a 40 delta is a good starting point for selling a put option on a stock that you want to learn. A stock that you want to acquire. Let's see. Is there a benefit to buying a 2-week debit spread deep in the money? You're going to have to tell me a little bit more about that, but I certainly don't think so, because the reason that I shouldn't say that. I would say that if you believe that the stock is going to make a big move in a very short amount of time, that is the only time where it makes sense to buy a 2-week debit spread. But if that trade doesn't go in your favor, I think what you're trying to say with the deep in the money part is that you're not paying a lot of time premium on that. So you could potentially do that, but it's also a trade that's actually very risky. A deep in the money 2-week debit spread, if the trade goes against you, you have no real way of, you're basically guaranteed a pretty big loss on that trade with almost no way of getting out of that loss. With the longer term debit spread, you at least have some time on your hands. So if the trade goes against you and starts to drift back a few weeks later, you have the opportunity to get yourself back to break even. When you use a 2-week debit spread, those are your 2 weeks. You live and die by those 2 weeks. So you better be sure that the stock's going to make a move in those 2 weeks. Keith, you picked an April option on Apple trades. Isn't that too much time? There are March weeklies. I'm not sure which Apple trade you're referring to, Keith. I don't think we've done an Apple trade recently. If you sell a naked put and it goes below your strike price, but there are still 20 days left in the option, but the next day it comes back above your strike price, will they make you buy 100 shares? Then no, Scott. Only if the stock is below your strike price at expiration will you be forced to buy the stock at that strike price. Not if it happens before and it comes back above. Another word, how would you decide the right expiration date? So generally speaking, when you're buying, we usually go out about 60 days when we're buying, and we're selling, we usually go out about 45 days. So again, longer dated options when you're buying, shorter dated options when you're selling. Does it pay to roll up a long call leap option to finance and deep in the money short option roll up and out? Tony, if you don't mind, there's a lot of moving parts of this. If you don't mind sending me an email at info@optionsplay.com, I'm happy to take a look at that. But um, too many moving parts to look at, very quickly here on a webinar. How do I keep the vertical till expiry or get out before the expiry date? Or do I keep the vertical till expiry or get out before the expiry date? So I would say with the debit and credit vertical spread, both strategies you should not hold to expiration. Generally speaking, there are very few strategies that you should hold to expiration. A short put is one of the few if you want to own the stock, because that's the whole goal, is that it does get assigned to you. Aside from that, there really isn't a good reason to hold these strategies to expiration. You're better off rolling them or closing them out before expiration. Thank you for explaining delta and how to find it in the OptionsPlay platform. How is delta calculated? You would have to learn a little bit about calculus to calculate delta. There are formulas. You can use either binomial model or the Black-Scholes model, but it does require a bit of calculus to derive those formulas. I don't necessarily recommend you to go and do that. I mean, that's what platforms like ours are designed to do. And it would take you quite a bit of time to derive them by hand. If you expect a big move to the upside, would you sell a bull put or bull call spread? If you expect a big move, that's what you're looking for. A big move means that you should buy a bull call spread. That's what we were talking about before in the Apple example, right? If you're expecting a big move, the call spread will generally risk less to make more. And because if you sold a bull put spread, it doesn't matter how much the stock goes. The most you can make is that income that you collect. So if the stock makes a big move, you're going to make the same amount of money if the stock doesn't move at all. You missed IV in covering Greeks. So IV is not, Greeks and IV are two separate things. Greeks tells you the sensitivity of an option to different things. IV is what the price of the option is implying, what the future volatility of the option is going to be. So Naresh, I actually have a webinar on our YouTube channel on advanced understanding of volatility. So if you want to take a look at that, that is one of the videos that I do cover implied volatility in a little bit more detail. Anthony, when is the daily play posted? It's always posted at 6 a.m. every single morning to your email inbox. And we also always have it as a pop-up on your screen. Mo, hello, Tony. Quick question about selling cover calls automatically after selling a put. Example, if I sell a put on stock XYZ at $10 and the stock drops to $9 by expiration, how do I automatically sell a cover call as soon as the system make me buy the stock at $10 result of selling the put? No, I'm not sure what you mean by automatically. You're not going to be able to automatically. You're going to have to go in there Monday morning after the stock is put into your account. You can then go in and sell a call. I don't know of any brokerage firms that can automatically sell a cover call on your behalf. Is it good to roll out the put option if the put option is losing and will expire soon? So Gary, here's my thought. Don't throw good money after bad money. If you bought a put and it's losing money and it's about to expire soon, that means your bearish view on the underlying stock was wrong. So the question is, do you still believe the stock is going to move lower? If you believe the stock is going to move lower, then decouple the two trades. First of all, get out of your first trade, which you have to admit you were wrong on in terms of the direction, and then ask yourself again, if I wasn't losing this, if I hadn't lost money on the previous trade, would I still take another bearish trade on this stock? You'll find, I tend to find when I ask that question a different way to clients, 9 out of 10 times the answer will be no, I would not get into another bearish trade on this particular stock. So decouple the losing trade from the fresh trade. That's the best way to think about it. Don't throw good money after bad money trying to make your investment back. When selling a call or selling a put for income, You are recommending deltas of 20. What about gammas? Carlos, number one, selling cover calls, you want about a 20 delta. Selling short puts, you want about a 40 delta. So much higher delta on short puts than cover calls. As far as gamma goes, this is why we sell 45-day options, because gamma is relatively low in a 45-day option. That's why we buy them back at roughly 21 days. Now that's for cover calls. Gamma is not something you really have to worry about in a short put for the most part, because the whole point of a short put is to help you acquire the stock. Gamma doesn't matter if you're holding something to expiration or if your intention is to hold it to expiration. Gamma is really only something if you're trading an at the money option that's close to expiration. That's really the only time you care about gamma. But with a cover call, you're selling 45 days out, you're buying back 21 days. During that period, gamma is not really that big of a factor. Only when you get into that last week and your option is near the money, that's when gamma becomes a factor. At the bottom of your platform screen, I see liquidity, earnings, and credit spreads. How do I access these reports? Wayne, I don't know what you mean by how do you access them. You click on the link to access them. Now that the market is not as bullish anymore, are credit spreads a good idea? So Guillermo, I will say implied volatility has come down substantially, right? The NASDAQ implied volatility is down about 21. VIX is just probably below 19, below 20 now. So credit spreads are not as attractive, but remember 20% vol on SPX is still substantially better than the 12 vol we had back in January and February of last year. So I would say 20 vol is still not bad for selling credit spreads. Certainly not as good as a few months ago when vol was trading at 25, 27%. But I still think it is suitable time to sell credit spreads, probably a little bit more so leaning towards the call side than the put side as things kind of slow down in terms of momentum here right now. But I don't think it's a bad time to sell credit spreads, just not as good as it was a few weeks ago. If you sold the put, what's your guide to exit or close the trade? So selling a put is, again, a strategy to help you acquire the shares that you want to own. That's the only time you should sell a put. You should not sell a put because you're trying to collect income. It's just not a very good strategy for doing so. You have to put up so much capital to sell a put, and you're collecting a small percentage of that capital. And if you never intend on owning that stock and you are taking on that risk of having to purchase 100 shares, it's just not worth it. Sell a credit spread instead. But if you're going to sell a put, the goal is to hold it to expiration and either own the stock or keep the premium. Calendar, butterfly, and other strategies don't always work in every case. Sam, I'm not sure if there's any strategy that works in every case. If there was, I think everyone would be trading it. So have to be careful with strategies. You're absolutely right, Sam. But again, there's no such thing as a strategy that works all the time. Julie is saying, I was looking at selling puts and credit spreads on the platform. Sometimes the return shows up as negative return, although the trade resulted in premium paid. I don't understand why it showed as a negative return. Julie, I'm guessing what happens was that you had selected maybe a bearish trade, and then you selected a bullish. You had first selected bearish, then you looked at bullish, and then you went to the P&L simulator, because the P&L simulator defaults to whichever side that you originally looked at. So if you have bearish, it automatically defaults to a bearish view. So your bullish trade will always have a loss if you have a bearish view on it. So that's the only thing I think that's what you're referring to. And you can adjust it by simply moving it over to I'm bullish to see the bullish profit potential. Does dividend value enter into your decisions? So Ira, it does and it doesn't. Most of the strategies that I trade don't really, first of all, dividends is a problem if you're holding an option near expiration and you have relatively small amounts of extrinsic value, and the dividend amount that's being paid is greater than the extrinsic value of the option. But this is part of why we roll options 21 days from expiration, is so that we never have to deal with these types of headaches. The more headaches you add into your plate, the more likely things that will likely go wrong. So the rules that we put in place, selling 45 days out, buying back 21 days before expiration, are all to prevent these types of different things like dividends that you have to factor into play. You don't have to deal with any of those things if you follow these types of rules. So that's why those rules are in place. Hi, Tony. How and when do you close a vertical put? It depends on whether we're talking about a debit vertical put or a credit vertical put. Ramjeet, I think what the best thing for me to do is point you to our YouTube channel. We have videos on both credit spreads and debit spreads. And I go in depth into what are the rules that we use to decide when to close and when to hold one of those trades open. I have a question about bid-ask spread. How long before should I close my vertical spread? I'm not sure what that has to do with bid-ask spread. Should I close early if bid-ask spread is getting bigger? So I don't think you should use bid-ask spreads in helping you decide whether you stay in or not. Spreads on a stock usually don't change very often. If they do, they tend to be small intraday fluctuations. They generally don't last very long because stocks like Apple will always be liquid. They're not going to change liquidity overnight. Stocks don't go from very liquid to not liquid or not liquid to very liquid overnight. That just doesn't happen. So bid-ask spreads are not in any way good shape or form a good indication as to whether you should stay into a trade or not. Far better, what you should be looking at is your percentage profit gain or loss. That's how you should determine when you get in and out of a trade. Is theta value constant? No. Theta changes as you get closer and closer to expiration. Theta gets bigger and bigger as you get closer and closer to expiration. I have a question. What delta will you choose when selling a put and determining your strike price? So Donald, as a general rule of thumb for selling puts, we usually start at about a 40 delta. Tyler's saying, will straddles be incorporated in daily and weekly recommendations? So yes, we are continuing to. We've just recently updated our straddle and strangle report here. We've recently just updated our straddle report to include both straddles and strangles, right? So we've added both of straddles and strangles. So yes, this is now live and this is now available to you. And for those of you that join me, the link to this is trade.optionsplay.com/@the-money-straddles, which I just posted a link into the chat window. And we're currently putting together one site where all of these reports live so that you can get access to everything all at once. Okay, I've answered questions for about 35 minutes or so. Thank you so much, everyone, for taking the time out here this afternoon. I really hope that you guys find this useful and giving you a better understanding, again, of the fundamental building blocks of these option strategies that you'll see us use here at OptionsPlay on CNBC. If you can understand these fundamental building blocks, you'll have a much better, a much easier time navigating option strategies, especially more complex strategies. It's one thing to just follow what someone else does because someone else told you to sell a credit spread. It's a whole nother thing to truly have an understanding as to what you're trading. And that's what I hope you were able to learn here today. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys tomorrow bright and early at about 8:30 a.m. for our rapid fire session. Thank you so much and have a great night.